Hey guys, today I want to talk about a type of investment we haven't covered yet on the channel, and that's real estate. Now some of you are probably saying, that's cool, but I can't even afford to buy my first home at this point, so how the hell am I supposed to be able to have investment properties? Don't worry, there are ways of getting into the real estate game without needing tens or even hundreds of thousands of dollars on hand to scoop up properties. Let's find out how. So there are three main ways to invest in real estate. The first being buying investment properties and becoming a landlord. The second is crowdfunding options for real estate. And the third is REITs, or real estate investment trusts. We're going to look at REITs today, but if you want a video on the other two, leave a like on this video and drop a comment down below and let us know that you want to see it. Okay, what is a REIT? Real estate investment trusts were created by Congress in 1960 to give small investors access to real estate investing. Unlike traditional real estate, REITs are traded on the stock exchange, meaning your money isn't tied up the same way it would be if you owned a home that you were renting out. REITs are basically a company that owns a portfolio of real estate that they're collecting rent on that you can invest in just like you would any other company on the stock exchange. It's important to note that REITs are required by law to pay 90% of their income back to their shareholders though, unlike regular stocks. Yes, I did just say 90%, but let's look at some pros and cons of them so you can get the full picture. The first benefit of REITs is that they're the best way to have real estate in a portfolio without really any barrier to entry. You won't need a big down payment or to go through the hassle of finding a good property buy in the first place, dealing with real estate agents and mortgage brokers and all that kind of stuff. The second benefit is that your money is more liquid than any other type of real estate investment. If you need to cash out of a physical property, you would either have to sell it or pull money out somehow using like a HELOC or something like that. Even when it comes to crowdfunding options for investing in real estate, your money can be locked into that investment for a few years sometimes without the ability to access it. With a REIT, you can just sell it on the stock exchange when you need the funds. The third benefit to REITs is that they pay a higher than average dividend compared to things like the S&P 500. This is because they pay out 90% of their profits back to investors. REITs are popular among people building passive income portfolios for this reason, since they can get good returns with the dividends compared to other kinds of investments. While we're on the subject of making money on REITs, you can also make some money by using my referral link to Webull in the description by getting a free stock when you sign up for an account and another free stock when you make a deposit. If you do, I'll get some free stocks as well. Not to mention I'll also get a piece of my ginger soul back and be one step closer to rejoining humanity. If you want to know more about dividends in general, we have a video on that. I'll put it on the end screen at the end of this video. An important note about REITs, just like any other dividend paying stock, is the stock price will usually fall by the same amount that their dividend payout is going to be on the day that they have the payout. An example would be that you have a dividend paying stock like a REIT that costs $100 and their payout was $10. You can expect to see the stock price fall to $90 a share the day that that dividend is paid to investors. This is usually seen by investors as a buying opportunity, and they will buy up more stock, which raises the price back up pretty quickly. Well, that happens if the stock is worth holding at least. So let's look at cons now. The first being how their dividends are taxed. With a normal dividend paying stock, the dividends you receive are usually taxed as long-term capital gains. This rate for some households can be 0% and for the majority will be 15%. As of right now, taxes do change, so don't take my word for it, check that yourself. But REITs aren't taxed as long-term capital gains. They're taxed as ordinary income most of the time. So your taxes on your dividends will depend on how much your income tax rate is, which is usually much higher than the long-term capital gains. One way to avoid taxes while investing in REITs is to hold them inside a retirement account that is tax advantaged, like a Roth IRA. We also have a video on types of accounts that cover some of these things. If you have a tax question or are new to investing, I recommend talking with a tax professional in general so you can get advice on your specific tax situation and strategies that you can implement to avoid losing your ass to taxes. Another con is property-specific risk. What I mean by this is that not all REITs invest in the same kind of real estate. Some focus on residential, while others focus on commercial and many other subsections of real estate. If you are invested in a commercial real estate REIT that has office buildings and companies opt to start having their employees work from home full-time, and those offices can't find new tenants, well, you're kind of screwed in that situation. Just be aware of these risks going into it and always do your due diligence like you would for any other stock. The last con is that REITs can be vulnerable to things like interest rate hikes more so than typical stocks. The market as a whole would most likely be affected by interest rates increasing, but REITs would feel this more strongly and might stay depressed longer in comparison due to the fact that they are directly affected by interest rates. So what if you don't want to put the time and research into figuring out what REIT you want to get? Easy, just buy a REIT ETF. Just like any ETF, this is a solid way to get exposure to a large number of REITs and their dividends by just buying one ETF. This is a popular way to mitigate risk by being highly diversified in the market. If you're invested in one REIT that focuses on hotel properties and hotels nosedive, you're going to feel all of that drop. If you're in a REIT ETF that has hotels but also a bunch of other companies with other types of properties, you won't feel that dip nearly as much, if at all, depending on how the other holdings are doing. If you're curious about ETFs, we have a video on them comparing them to mutual funds that you can click on at the end of this video. An example for you of a REIT ETF is VNQ from Vanguard. This fund has just over 170 REITs and other real estate investments. You can see a complete allocation breakdown on Vanguard's website, and this will also give you an idea of just how many different types of real estate you can invest in through REITs. VNQ holds residential REITs, industrial REITs, and healthcare REITs, as well as many others. If you want to learn more about REITs, I encourage you to get on our iOS app, Android's coming soon, chill out, using the link in the description to connect with other investors to help you learn or to share your ideas with other investors. You can also join our Facebook group with over 26K members too if you trust Zuckerberg, which is debatable. Thanks for watching, everyone. Take care.